Now the time where Gregg has been preparing all week long to show you how your income portfolio is doing, man. You ready for this?
Yeah, I'm ready.
All right, Sachi.
All right, my friend.
This is your life.
There we go. There we go. Let's look at all the hard work and the dedication and the leap of faith that Sachi took 4 years ago and look at it in terms of his portfolio with JWB. On the right here, you see all of his purchases. And when clients own these 8, 10, 12 properties, it's really hard for us to put it all on one slide, Sachi. But what you see all there are all the purchase prices, the loan interest rates, and like we talked about, Sachi, not only from an appreciation perspective, did you nail the timing on it, but your interest rates, incredibly low. I'm so happy that you have this asset with an interest rate that's locked in for 30 years if you'd like it to happen, because that really puts you in a position of financial strength.
This looks like mostly renovated homes with a couple of new construction. I feel like this one looks like a new construction. Sachi, what was your thinking there?
Going forward, I want to purchase only new construction. And that was the only one. So for the 1031 exchange, I only had a certain amount of time to identify properties, and it was a little bit harder, put a little pressure on me. I think I spoke to Brandon at the time. He was able to throw one in there for me. And it was actually under construction, I believe. They were able to finish it. But going forward with number 9 and number 10, I do want them to be new construction. I think it's more beneficial in the long run.
Let's talk about that. Why do you think that is?
Less maintenance issues. You get a longer life of use on it, and it appreciates a bit more, I see.
Some of those things are correct, and some of those I'm going to challenge you on a little bit. On the maintenance one, right? You see slightly lower maintenance costs when it comes to new construction homes than renovated homes. On a renovated home, you're expecting about a 7.5% maintenance rate compared to the rents that you earn. And on a new construction home, it's about 4%. So there's a little bit of difference there. So you're right about that. But most people think that new construction homes appreciate more than renovated homes. That's actually not the case. There's no difference. There's no data to support that a home that was built in 1970 appreciates more than a home that was built in 1950, right? And for those who are owning this JWB portfolio, you're planning on owning for 10 years or 20 years. At some point very soon here, even the new construction home that you buy today, you're not going to call that new construction in 3 years or 5 years, and it will perform just like a home did from 1980s or 1990s or 1970s or 1960s. The new construction appeal there is at the date of purchase. But in the long run, your home price appreciation rates, there's not a difference between if it was new construction or if it was 10 years old, or if it was 20 years old, or if it was 40 years old. They all appreciate over time. So keep that in mind going forward. And I just think you are going to love your performance on your renovated homes. And so I love new construction and I love renovated properties. And that's what I would advise you to do the same. You absolutely nailed it when it came to the team and the market and the property, whether it's new construction or a renovation. It's like a widget, man. It's like a widget. It really is. And I think to the eyes, people look at new construction and say that's a better asset because, listen, that makes sense, right? It's a prettier home. It's brand new. But at the end of the day, after owning these properties for 10 years, you're not going to see a difference.
Maybe I got spoiled because the cash flow on the new property was really good.
Yeah. Well, there you go. I think you make your decisions based on the numbers. And if it happens to be a new construction home, that's awesome. And if it's not,
It was really good.
that's okay too. You're going to see your numbers here in just a second. You'll see what I mean.
Yeah.
That's cool, man. All right. Learn something new. So what I hear there is like less pressure, right? So next time you come across a pot of money, if it can get you 2 renos versus 1.5 new constructions, you have a little bit of ammunition to think about a little bit different, right?
No, it makes sense. Yeah. Thanks for.
So let's take a look at just how this is performing. And your highest return on investment property, guess what? It's a renovated property.
Wow.
There we go. So this is the home on Portsmouth Avenue. I guess I'm just curious, prior to looking at this data, would you have said that your favorite property is the new construction property that you had?
Right now, yeah. I mean, it's nice to look at too.
It's nice to look at.
Yeah.
I'll grant you that for sure. Does it surprise you that your actual best performing property is this renovated home on Portsmouth?
Yeah, it does.
You have a number of high performing properties, so I'll give you that. But this one actually is the highest performing property at 15.94% annualized lifetime returns over the 4 years that you've owned it. And again, this isn't even including home price appreciation, which I'm going to add for you at the end of our session here. So That's your highest performing property. But I always like to show the lowest performing property as well. I think truthfulness and authenticity and showing the good and the bad of this asset class is important. So let's look at one that didn't meet expectations over the first 4 years.
I'm just going to say 16%. It's pretty good.
I know. I just went
Without appreciation, man.
I know.
16%.
I know.
That's nice.
So here's our property on 29th Street. Okay. You can see that we are at -8% returns, not including home price appreciation. Let's lean into this a little bit. Sachi, tell me about your experience with this property.
I purchased this property in April of 2022. And I believe 2 months after I purchased it, there was a termite issue.
Is that what it was?
Yeah, that's what it was. Actually, JWB came to me, said there's a termite property. And because you just purchased the property, we're going to handle absolutely everything from A to Z.
No way. We did that. Honestly, I reached out to the team late last night because I wanted to get a little bit more information because this is unusual, but I didn't check my emails before the show. So I didn't even know how we handled this. So talk me through that a little bit more. So we took care of the entire issue for you?
Yeah. So right after purchase, the tenant in the property said that there's a problem with the walls, and JWB did an investigation. They found out, there was termite damage at the property. And I think Kyrie I spoke to, he basically said JWB is going to cover everything from A to Z in regards to this damage. Because you just purchased the property, we should have known that there was some type of termites living in the property. I believe JWB covered the termite pest control. That was a few $1,000s, maybe even $5,000 to $6,000. And then they also covered the turn costs of the property. That was like another $5,000 to $6,000. So it was well over $10,000 JWB covered in order to get this property back to working condition.
Wow.
It did take a few months. That was a little bit annoying. Like I said, eventually they got it back to working condition.
Yeah. You can see that in 2023, it's performing just like the other property is performing. I think it's really important to talk about this because in what we're trying to make is this asset class as simple and enjoyable as it can be for investors. But the reality is this is a messy asset class behind closed doors, right? You're in the people business, and sometimes things happen in properties that you just can't expect. And I think it's important for you to know that when you own 8 properties, you're going to have one of these moments where something just doesn't go according to plan. And that's when you really need to have a team that is going to operate to their core values, that's going to do the right thing for you, even if it's not in the contract. Right. And I didn't know that our team did that, but I'm not surprised. Right. When something out of the ordinary happens and it's something that flat out we just missed, or maybe we couldn't have known, there's always an opportunity for us to do right by you. And so I'm really glad that we've done that. And then we're set up for success here. This is a little bit misleading because in 2023, we only have probably 4 months of data showing here. But just seeing how this asset is going to perform, it's clearly going in the right direction, and it'll be just performing just like the other ones are as we continue to monitor your portfolio.
GC, 2 questions. One, is that number whatever that like alleviation cost that JWB would throw in, would that be part of this like calculation also?
It is. So
Okay.
There's other costs that Sachi still experienced, right?
Okay. So that's still the real return.
Yeah, exactly.
Okay.
I did a deeper dive, right? And his rental income was lower than what it should have been for last year because, and Sachi, feel free to correct me here if I'm a little bit off, but we had to move the resident out. We had to do a turn of the property. The resident moved out. So his rental income was lower than what we would have expected, right? He had higher vacancy cost in year 1 than we would have expected. And that leads to it. I think there were some other costs that were not related to this, to the termite work that we did that Sachi probably had to bear as well. So higher on the maintenance and vacancy cost than we would have expected on the eval. Something else to keep in mind, though, is that in your first year, it always takes time to get to that level of performance that you see on the eval. And the biggest reason is because you have costs up front. Your property management, your tenant placement fee is a cost that you experience day 1 when you own the property because your home is rented. And so it takes time for the property to perform even when it's working well. But when you throw in an unexpected circumstance like this, that's when it can start to go more negative, although it would have been a whole lot more negative, and Sachi wouldn't have been nearly as happy as if we didn't step in and do the right thing there.
That's cool, man. That also makes me think of what you were telling me this morning on the run of somebody very close to you being in this syndication where the operator is underperforming and they're still taking a rip off of their management fee.
Yeah.
And like the idea of I don't know. You want to just say it as quickly as possible so we can.
Yeah. And I think this is good for a future show, but
Yeah.
there's so much operator risk when it comes to syndications. And you just don't have that when you get into the turnkey real estate investment space. When in the syndication world, if you want to get your money out and the operator says no, you can't get your money out. And they might put a 5-year projection of when you get your money out on that syndication. But guess what? They can just close redemptions on you. Even if you're not at that 5-year window, if you're past that 5-year window, they can just say, you know what? Nah, I'm not going to do redemptions, meaning that you can't get your money back out. And so one of my family members is going through that right now. And it's been a really painful process. And it just highlights the risk of operator when it goes to syndications. Here for Sachi, right? Sachi owns this asset. So he's supported by a world-class team. But if Sachi made the decision that he wanted to get out of this investment for whatever reason, Sachi does not have to answer to JWB. Sachi owns it. That's different when it comes to syndications.
Big deal. All right, man. You ready to see your whole portfolio performance here as we do the big reveal? You want to go one by one?
Sure, let's go one by one. All right. I feel like it adds the anticipation here. So we talk a lot about how this asset class is built on an asset that pays for itself every single month. And that cash flow that you get right off the bat is not the reason to invest in rental properties. It's not cash flow immediately. It's cash flow when you need it. Now, Sachi has experienced significant rent growth over the past 4 years, but I can tell you that the cash flows that he bought those properties with were not anywhere close to $18,000 of net rental income coming in. And that's the beauty of this asset class. It's not cash flow immediately. It's cash flow when you need it. So your first profit center, Sachi, is net rental income, and you've earned almost $18,000 from your 8 rental properties here. Congratulations.
In 4 years. Pretty good.
Next, we've got tax savings. I love me some tax savings. Sachi, you love tax savings?
Tax savings is great.
Yeah. Can you what does tax savings mean to you?
Oh, paying less taxes,
There you go. It's a beautiful thing. In owning rental properties, you get these tax advantages that everybody on this call is able to get. You don't have to have any special certifications, and they just allow you to defer taxes on your real estate profits. And you just get it simply by being in this asset class. So your total tax savings to the tune of roughly $9,000 that you've kept in your pocket and on taxes that you did not have to pay on the income that you earned. Next, we've got our third profit center, which is principal paydown. Principal paydown is amazing. This is your residence paying down your loan for you. Which do you like more, tax savings or principal paydown, Sachi?
Well, I like principal paydown.
Yeah.
Well, it's always a good feeling someone paying down your loans.
It's a beautiful thing. And not enough people even think about it or factor it into the reason why this asset class tends to win over other asset classes. But look at you. You've had $28,000 of your loans paid down, not by you, but by your residents. If we can all just take a second and think, oh man, how cool would it be if I could just find somebody that would just pay my loans off for me? Well, that's what you have when you buy rental properties that produce positive cash flow like Sachi has. So we love that profit center. Next, we've got our home price appreciation. Home price appreciation is the biggest contributor to your return on investment. Sachi, what were your thoughts on home price appreciation prior to investing with JWB? And maybe what are your thoughts now on it?
Prior to investing, I was only looking at maybe 2 to 3% year after year appreciation, but it's obviously been a lot higher than that. It's a good feeling. Eventually, if you want to take out some equity and use that to maybe purchase another house, you could always do that.
Absolutely. You had options to invest in other markets that produced more positive cash flow, but had lower growth over the last 40 years and lower growth potential going forward. How did you make that decision to invest in Jacksonville, which has higher upside than other markets?
Like I said, I was looking at like the future, I would say outlook of Jacksonville, and I seen that the jobs, population, everything was going up. There had to be some value in the real estate eventually.
Yeah, you're looking at the dynamics that drive higher home price appreciation, population growth, right? Economics, right? Jobs that are being created here and headquarters that are moving here. And all that translates into demand for housing. And when you have population growing and you have jobs coming here that's raising median incomes, that allows for higher than normal home price appreciation. So you nailed it on the home price appreciation realm. I am the first one to tell you and everybody else that's not sustainable. You're not going to get 10 to 15% appreciation year over year. But I'm super happy that you invested when you did. and you've earned over $171,000 in home price appreciation of your assets.
Let's go.
And then lastly here, inflation hedging, which I know you're a big fan of. This inflation hedging is going to help you. This is that pension for you, which is inflation protected, is a great way to think about your portfolio here, Sachi. And as inflation is 2.5 times higher than what it should be right now and has been even higher than that for the past year, this is an asset that is growing in rents and home prices over time. It's going to protect you to produce those cash flows for you when you need it.
Yeah, I noticed that the rents are going up pretty well.
They are. And over the long haul, they're going to continue to go up roughly with the pace of inflation, which should be, call it that, roughly 3% figure there. All right, so here we go. So here's the big slice of the pie here. And I think many investors miss this, right? When they're making their decisions on where to put their money, they don't pay attention to all 5 profit centers. But when we look at all 5 profit centers, there's a reason that we need to be in a growing market like Jacksonville. And it's because the biggest piece of the pie here is 76% of Sachi's returns have come from home price appreciation. So if you're not factoring in the market, if you're just saying I'm going to buy rental properties because it's next door to me, you're missing out on potentially 3/4 of the pie of your overall return on investment. And I would encourage you to do what Sachi did and to find that market that leads to higher growth, because it will increase your overall returns.
Sachi, we show these things every week. I always call this thing the Pac-Man, right? It's like you see this pie chart of profit centers and it's always home price is the Pac-Man. Everything else is the mouth of the Pac-Man, man. You got a perfect Pac-Man here, right? You got this like perfectly open mouth with your rental income, which is great. The tax savings, your principal pay down that you love. And then this big blue Pac-Man right here, which I know that Gregg's colorblind. So we got to tell him it's blue.
There we go.
But that's the Pac-Man. And here's the big reveal.
All right, Sachi. So when you made the decision to put your money with JWB, you brought a little over $386,000 to your investment portfolio with us. Happy to report that current portfolio is now worth $612,948, my friend.
Wow.
Your expected return when you put your money with us was 10.6%. But because of the great decision that you made based on the team, the market, and then the properties, your actual returns on investment come in at 23.8%. Super happy for you, Sachi. What do you think?
That's awesome, especially since most of the houses came within less than a year ago. And I was able to see that big difference.